I think we need to understand now how the economy works. And the best way to start on this is to look at banks. Now, if you go out in the streets and you ask anyone, what's the most important thing in the economy? Most people will say things like money, banking, hard work, but they will certainly mention the monetary side. If you ask an economist, they will talk about anything, but not money and not banks. As I'll try to show you today, economics has been one of those research disciplines where a lot of control was implemented very early on. In fact, I think it's been the model for what's been happening in other disciplines, including medicine, medical research much more recently, where you have false theories that are being proclaimed and dissidents are being suppressed and the truth is being suppressed. I think we all know and we all sense banks are somehow important. So let's talk about this. How do banks actually work? Now, you may be surprised to find that for the last century there have been 3 theories of banking. Now, these are 3 different theories. They're contradictory theories. So the experts hadn't actually agreed on how banks really work. The dominant theory is the financial intermediation theory. That's still proclaimed today. Banks are not so important. They're just financial intermediaries. They gather deposits, do the analysis, then lend out the funds. Just like other non-bank financial players, and also just like financial markets in general. So you don't really have to worry too much about banks. Nothing to see here, walk on. That is the dominant theory. Then a slightly older theory, dominant from the 1930s to the 1960s, is the fractional reserve theory, which said each individual bank is just an intermediary, just like that. It's not important. But somehow, this theory still admitted, somehow something is happening in the banking system. And as these banks interact, somehow money is being created. Of course, if you listen to that theory, then you'd realize, okay, there is much more to this. They talk about the money multiplier. Wow, what is that? The money multiplier? That sounds interesting. So I guess when this theory was dominant, they realized, okay, this is still too much information in here. And that's when they introduced the financial intermediation theory. That's now in the textbooks. No more money multiplier, no more money creation in the banking system. But in the fractional reserve theory, each individual bank was only an intermediary. And we have the third theory which says, no, that's wrong. Each individual bank is not a financial intermediary. Banks don't intermediate. Banks create money. Each individual bank creates money out of nothing, which is perhaps the most radical theory. That one was dominant until the 1920s, 1930s, 100 years ago. Now, which one is correct? I guess the scientific thing is to conduct an empirical test of those 3 theories. But you'd be amazed to hear that for this whole century, no such test had been conducted. Because the way economics has been operating is to just proclaim something and suppress alternative views without the scientific basis, something very familiar from the last sort of 2 years in the health sciences. Now, these 3 theories differ in the question of where the money for a new bank loan comes from. So if a bank gives you a loan, a mortgage, the question is, where does that money come from? And that's where these 3 theories say different things. The financial intermediation theory says it comes from other people's deposits. The fractional reserve theory says it's from excess reserves at the central bank. And the credit creation theory says it comes from nowhere. The banks just invented. Each bank, each local small bank, even Raiffeisen Bank, local community bank, every bank, whether large or small, when they lend, they just invent the money. So this is the textbook story, which is the financial intermediation theory. Banks gather savings, do their job, and then lend out money. And the older story, fractional reserve, the banks put some money with reserves in the central bank. But the third theory had not really been taught for a century, the credit creation theory. And we need to do some empirical tests. Now, economists say banks are deposit-taking institutions that lend money, which seems reasonable. But in social sciences, we have the advantage that the rules, the laws of the social universe are man-made. If you're a physicist, your job is to discover the laws of physics, to discover the laws of nature that have been implemented, and you can't change them. Of course, in social sciences, the big difference is we can change those rules, and the rules are the law. So let's take a legal approach first and check whether it's true that banks at law are deposit-taking institutions that lend money. And what we find is that actually, no, banks don't take deposits and banks don't lend money. And you see that in the law. Because at law, a bank deposit doesn't exist. A bank deposit is simply a loan that you give to the bank. So there is no such thing as a bank deposit at law. Secondly, banks don't lend money. Banks are in the business of purchasing securities, IOUs, debt instruments. Now, when you get a loan from the bank, you say, well, I don't care about those details, give me the money. The bank will purchase your loan agreement, your mortgage agreement. That's an IOU, a debt instrument, a security that you, the borrower, is issuing. And then you say, just give me the money. And the bank, if they're careful, they will say, you'll find it in your account with us. If they say, we'll transfer it to your account, that's incorrect, because no transfer takes place. But you will be credited that money in your account. And where does it come from? From nowhere. It's invented, because deposits are simply the record of the bank's debt to you, because there's no such thing as deposit. It's when you lend money to the bank. And if you borrow money from the bank, then the loan contract also obliges the bank to pay you something, which will be recorded as a deposit that nobody has paid in. It's a fictional deposit that the bank invents and credits you with it. And that is how our money supply is created. So we've had these three theories of banking. And money creation doesn't come in the financial intermediation theory. In the fractional reserve theory, individual banks don't create money, but systemically they do. And in the credit creation theory, each bank creates money, the system creates money. But which one is empirically correct? So I conducted the first empirical test a few years back in the 5,000-year history of banking, and the answer was, well, the financial intermediation theory was rejected. Essentially, I took out a loan from a bank. The bank had to cooperate with me because I had to look inside their system and their operations. What do they do? And I confirmed that, no, the deposits are not touched when the money is paid out to me. The reserves were not touched at all. So where did the money come from that I borrowed? It was just invented out of nothing. There's two papers on this, 2014, 2016. Can banks individually create money out of nothing? If you Google that, you get the paper. It's one of the most downloaded papers in all of Elsevier's scientific publications. So the textbook story is wrong. Banks create money out of nothing. And here's how it works. As I said, the bank will purchase your loan contract, put it on the asset side of the balance sheet. That lengthens the balance sheet of the bank, and then as the bank pays out the money, in inverted commas, it credits the borrower's account with the same amount, which is a bank liability. And the test was about, where does this money come from? It's not transferred from anywhere inside the bank or anywhere outside the bank. It's newly created, and of course it has to match because you've lengthened the balance sheet. And that's how our money supply is created. That's where 97% of our money comes from. The banking system creates it out of nothing. And that's, of course, why banks are important. That's why banks drive the economy, and their decisions reshape the economic landscape. This is called credit creation. So banks create money through the credit creation process. That makes banks very powerful. They make this decision of who gets new purchasing power and for what purpose it's used. Of course, central banks are the powerful institutions that can control the banks and tell them what to do. And very often, they conduct their monetary policy by guiding bank credit, but they usually don't talk about it. They usually don't want people to realize that this is how it works, the fact that banks create money out of nothing, and that monetary policy really only works if it influences bank credit creation.